What's up, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to be taking a look at Walgreens stock, ticker WBA. This is a stock I've been buying shares of now for a couple years, and we're going to take a deep dive into this company to see if this is currently a good investment. So first thing we're going to look for is the stock chart. And if we look at the stock chart over the last 5 years, the stock's down 47%. In the last year, it's down 23%, and it's now trading at a market cap of $31 billion. So you can see here, this is a significant investment of mine, 115 shares at $45 a share. So, and I'm down 20% on this. So not the best scenario, but I'm trying to remain optimistic and we're going to hope for the best. So first thing on my checklist is revenue, and then we're going to look at net income. So revenue, they've done a great job growing revenue. In 2022, they did $132 billion of revenue. So that's great. Net income, also a fairly good job with growing net income. In 2022, they did $4.3 billion, which is still a large amount, but it's a very slim margin because for doing $130 billion of revenue, you would think the net income would be a little bit over, would be a lot more than $4 billion, but it is what it is. Overall, both I would give a check to. Then number three, looking at the price to earnings, it's trading at a very cheap PE ratio. This is a forward PE ratio of only 8. So that's one good thing going for this stock. If we look at number four, I wouldn't consider this company innovative at the moment, but I would consider them to have a pretty strong moat because they do have over 13,000 locations. And I read a statistic that said 78% of Americans live within a couple miles of a Walgreens. So I would consider that a pretty strong moat because not any company can just walk in and achieve that. Number five, the industry is growing. So 75% of their business is pharmacy and the other 25% is retail. So the pharmacy business is expected to grow at 6% a year for the next couple of years. So Walgreens should pretty much grow at a similar clip to that. Return on invested capital, this one is tough because they had a really tough year in 2022, it looked like. But in prior years, it's pretty strong. So you can see from 2003 to 2011, it was anywhere from 18 to 25%. And then it kind of dropped off and like 12% became the new normal. And then in 2020 to 2022, it's been 2%. So not the best there, but usually it's over 7%. And if we look at a chart like this one is even more confusing because these numbers are completely different. So what we'll find is that in the latest quarter, they had a negative ROI, and also in 2020, they had a negative ROI. But before that, we're talking numbers between 8% to 18%, and it's normally hovering somewhere around this 10% mark, which is great. So I'm not sure which number is more accurate here because they're both, this is return on capital employed and this is return on investment. So they should be the same thing, but that's not what we're seeing here. But overall, it looks like for several years, they've averaged over 7% of ROI. So we'll give that a check. Healthy cash flow, I put a no, because for one, their operating cash flow has gone from 5.5 billion 4 years ago to now 3.2 billion. So that is a significant drop off. That's not good. They are investing pretty heavily into the business, which can be seen as a good thing. And then, of course, a decent amount of their income goes to dividends. And then we see 3.3 billion going to other financing charges there. They're in the process of doing several different acquisitions and also selling off parts of their business. So there's a lot of things going on. And then cash right now is at 4.3 billion, which is at a lot higher than where it normally is. And then free cash flow is also looking pretty weak. Normally it's in the $4 billion range, and we're at 1.4 billion. So not the best there. That's why they get a no. Diverse revenue streams, I put no. How I said 25% roughly is retail, 75% roughly is pharmacy. So not a whole lot of diversity there. Is equity growing? No, not exactly. We did see a little bit of growth. There was a jump. So 2019, we saw 24 billion. Then in 2022, it went to 30 billion, which is a significant jump. However, if you change it back down to the quarter, you're going to see that 30 billion quickly went back down to 24 billion. So they're back where they were 4 years ago. That's not really significant growth. Is the equity over 15%? No, but it's close though. So, oh wait, I'm sorry, that's wrong. $24 billion of equity. The company is only 31 billion. So I'm sorry, this is supposed to be a yes. So the score is actually 11 out of 16. Share count decrease. Yes, this chart was actually kind of weird because as you can see here, it shot up to 1 billion shares outstanding, and then now it's down 864. So definitely some drastic share buybacks there. But again, how I said, they're having a lot of things going on with merging and changing different parts of their business. Next up, healthy amount of debt. No, I would definitely not consider this healthy. If we're looking at current assets are 19 billion, but I don't like to count inventory. So let's look at cash and receivables. It's about $9 billion of cash, let's say. Well, they have 68 billion in liabilities. And to make this even worse, they lost a ton of money in the last couple of quarters. So if we look over here, it's not like they're pulling in tons of profit so they can stack up on cash. So Q3 of last year, they lost 400 million, and then Q4, they lost over $3.7 billion. So not the best scenario there. Respectable management, I put no for that very reason of how they're running how some of these numbers are turning out. Is cash more than average income? Yes. You could say, so cash is a little over 4 billion, and their net income is normally around 4 billion, 2 billion, and then it's, it varies. It jumps all over. So overall, I'd give that a yes. Healthy dividend, yes. Right now, I believe the payout ratio is about 50%, but normally it's like 30% because normally they're doing higher earnings. See, payout ratio of 38%, dividend yield of 5.2%, which is huge. So that's definitely nice to have that there. And this company is definitely over 20 years old. So overall, we get 11 out of 16. And so really, it's not considered a buy. Okay, but what I always like to think that there's certain companies out there, the giant conglomerates and corporations in the United States, I think that you can give them an exception sometimes because sometimes they might not have the best balance sheet, they might not have the best ROI numbers, and although those things are very important and these companies should still be held to that standard, they can sometimes get away with it because since they have such a large moat when you're at that scale and you have that type of brand, you can get away with things sometimes. I think it's definitely harder to go bankrupt when you're in these type of companies. So like they have 325,000 employees. This CEO, I was kind of hoping she would, because I put that the management was not respectable, but I was kind of hoping she would help turn things around at this company. I believe I know she worked at Starbucks, and she was an executive at another company too. So she definitely has the track record of success, but so far we have not seen her talent kick in yet. But I'm thinking that Walgreens could it keep going lower? Yes. Could it go out of business? I think that's very unrealistic. So, and we're talking about it's at a P ratio of an 8 right now. It's at a 7 or an 8. So it's almost, you would think this is as cheap as it gets, but we'll see. Could it trade down to a 5? Maybe the stock turns out to be $30 or $25 a share. That's possible. But I think there's a good chance that Walgreens turns things around and this stock gets back near $50 a share again. So that is my analysis for Walgreens. Thank you for watching, and I will see you guys in the next video.